Hello, everybody. Adam Bergman here, tax attorney, founder of IRA Financial. And on today's Self-Directed IRA tip of the week or story of the week, we're going to be talking about harvesting losses and reducing tax on Roth IRA conversion. So this is a topic that I think should get more highlight. It should get more focus because Roth IRA conversions are obviously a very popular topic, right? It makes sense, right? If you have a pre-tax IRA that would be subject to income tax when you pull the money out, let's say after age 59 and a half, the idea of shifting some of that income to an account that's tax-free, that offers tax-free distributions once you're over the age of 59 and a half and the Roth's been open at least 5 years, one of the most tax advantageous solutions out there, right? There's nothing better than sheltering all your income and gains from taxation, right? That is at the Mount Rushmore of all tax planning opportunities. That's why life insurance is such a very important investment solution, investment product, because when you pass and you have a beneficiary to a life insurance policy, they receive those funds tax-free. Okay, so that's an important reasons why life insurance should be part of everyone's tax planning and estate planning solutions. A Roth IRA operates much the same way as life insurance. But with a Roth IRA, you can actually use the money during your lifetime. You don't have to die to really have your family benefit from it. So the way the Roth IRA rules work is so long as you're over 59 and a half, the Roth's been open at least 5 years, whatever you pull out of the Roth IRA is tax-free. On top of that, there's no required minimum distributions when you reach the age of 73, like a traditional IRA. When you pass away, if you leave the Roth IRA to a spouse, the spouse can then use the Roth IRA during his or her lifetime, tax-free. And if you leave the Roth IRA to a non-spouse, then that individual has 10 years to pull those funds out tax-free. So not only is it a great tax sheltering product for your lifetime, it's also a great estate planning product. So you can know and have peace of mind that when you do pass, your family is going to have tax-free use of those funds. So obviously tax practitioners, tax attorneys like myself are always conceiving of thinking of ways of what is a tax successful or minimizing way to take a pre-tax IRA and then move it to this really, really exciting Roth bucket. Because when you do convert a pre-tax IRA to Roth, you have to pay ordinary income tax on the amount you convert. Not capital gains, but ordinary income tax, meaning the amount you convert, if it's cash, obviously it's super simple to determine the cash value. So for example, you convert $50,000 in cash and you made $50,000 as a W-2 employee, you now pay tax on $100,000. Obviously you have deductions, right? Maybe your standard deduction, charitable, mortgage, losses, which we'll get to in a minute. All those types of deductions or credits can reduce the amount of tax you have to pay. So the key to maximizing the tax planning opportunities from going to a pre-tax IRA to a Roth IRA is how do you reduce the tax bite? Okay, because we know that you have to pay ordinary income tax on all your income in the aggregate. So your W-2, your business income, 1099, Schedule C, plus any amount converted. Okay, so it's not hard to figure out that tax planners are always looking for ways to reduce the taxation. Now, this particular video is going to talk about loss harvesting. Loss harvesting basically means you can take losses from prior years, which can be carried back forward, okay, up to a general 80+% percentage, and use those losses, otherwise known as NOLs, net operating losses, from an active business to reduce taxable income from a Roth conversion. Okay, so remember I said that you pay tax from a Roth conversion based off the cash or the fair market value of the asset you convert, right? So if you convert a piece of land that you say is worth $50,000, that piece of land at $50,000 is added to your other income. It's not what you paid for it, right? Your basis is what you paid for it, minus depreciation or so. But your adjusted basis, what you paid for it, is not relevant when it comes to a Roth conversion. Your basis actually isn't even relevant for IRAs or Roths because you don't pay tax on the gains. In the case of a pre-tax IRA, you pay tax on what you take up. Okay, so for example, if you buy a piece of land for $30,000, and maybe you think it's worth 50, but an internet source says it's worth 45, but an appraiser may say it's worth 35, or your tax records say it's worth 33, what value do you use? Well, obviously you're going to take the value that's most beneficial to yourself, right? The lower value. Now, that may not necessarily be the right value. So you have to understand, and some people will take the highest one to be safe. Some will just take the lowest and just feel that if they have an appraisal letter, that will be sufficient evidence. Some will average them, take the middle number. But again, it's up to you to determine what the value is. The IRS does not have to accept your value, but I can tell you, just practicing law for 22 years, it's very rare for the IRS to contest a valuation on a Roth. Why? Because you're giving them pre-payment of tax, right? Without doing the Roth conversion, you don't have to pay tax on the amount in your IRA until you hit 73, and you have to start taking out required minimum distributions, which is 3 or 4% a year. Here, you're paying up front the tax. So we all know, we hear about government shutdowns and the need for tax revenue. The government loves tax revenue. They love having money in their coffers so they can spend it. So they're very, very unlikely to counter or dismiss any type of valuation on a Roth conversion. Could happen, very rare. I haven't actually heard of it. So that's something to keep in mind. So now let's talk about how do you reduce any potential tax bite. So the simple example, you make $50,000 at W-2, you convert $50,000, let's just say of cash, right? So you can't really play around with a discounted valuation. For example, if it was a piece of land or a minority interest in an LLC. And I'll do a subsequent video on discount valuations and Roth conversions, which is a really interesting topic. But for today's topic, that's not as relevant. We're going to assume that it's a cash value. There's nothing to discount because you can't discount cash. And we're going to add the W-2 and the $50,000 that you convert in this example. And we're going to assume you have $100,000 of gross income on your 1040. Remember, the $50,000 subject to ordinary income from a Roth conversion, not capital gains. So now how do you reduce that 100K, right? There's deductions, right? Charitable, maybe you have your standard deduction. It's also losses. Okay, so harvesting losses meaning, number one, you can use up to $3,000 of capital losses to offset ordinary income. So if you sold Tesla or Apple and you lost $3,000, you can use $3,000 to reduce your taxable income, in this case, from $100,000 to $97,000. Okay, you can't use more. You can use less. You can use $1,000, $100,000, $2,000, but you can't use more than $3,000. So even if you lost $12,000 when you sold your Tesla stock or Amazon stock, you can use $3,000 to offset ordinary income, and the rest will just be used to offset capital gains. Okay, so that's the first thing. You can always use up to $3K. The second is, do you have NOLs, net operating losses from prior years? Maybe you started a business with friends, maybe you invest in an active business, and those losses have passed through from an LLC. You can use those losses, and that's where the title of today's video comes from, harvesting losses, using those losses from a active business and then using them to reduce tax on a conversion. I say the word active in parentheses because you can't use passive losses, right? There's limitations on the use of passive losses, whether it's based off the passive activity rules under section 469 or the at-risk rules under 465. Without getting into too much detail, something that you can talk to your advisor about, but there may be limitations about how much of a passive loss you can use to offset active income, i.e. income from W-2 or a Roth conversion. So let's just assume everything's active just for simplicity purposes. But if you do have other passive losses from real estate or other passive investments, you should talk to your tax advisor and see if it's potentially available to reduce any of the active income, because there are some rules under 465 and 469 in the tax code, where you can take some Schedule E losses and potentially use them to offset other ordinary income. So let's assume you have no mortgage, there's no depreciation, mortgage interest deductions. Let's just keep it simple. You're going to do some charity deductions. You have a $3,000 capital loss, and now you have some losses from prior years, right? So maybe you, as I mentioned, you invested in an active business through an LLC and you've been allocated losses. Those losses, if they're from an active business, could be used as their NOLs to offset and add deductions to your 1040 to reduce your taxable income. Okay, so obviously it's a case-by-case scenario. The purpose of today's video is to really just issue spot, to let you know that, hey, be available. If you have a lot of NOLs from prior years and you're thinking of doing a conversion, it may be a good time, right? Yeah, the losses do carry forward, generally up to 20 years. And there is a formula that dictates how much of those losses can be used in a given year, which again, you should review with your tax practitioner. But when you are considering doing a conversion, that's something you should keep in mind, right? Can you pay the tax? What are you converting? Are you converting an asset you think will go up in value? What do you think your tax rate will be when you retire? If you think it's low, maybe a conversion doesn't make sense. If you're 85, maybe a conversion doesn't make sense. If you're 35, it may make more sense. And then, of course, can you pay the tax on the conversion, right? Let's say you made 50K, and you can pay the tax on 50K. You can't pay the tax on 100K. Maybe you don't want to do the conversion. And then ultimately, hey, you got a lot of deductions out there. You have losses you can harvest and use these losses on top of the $3,000 of capital losses. Are there other losses you can use to reduce your taxable income? Again, facts and circumstances test, something to be thinking about, because if you do have a lot of NOLs to carry forward, you can start using them to eat up losses. Now, maybe you only want to convert a little bit each year, right? You have $50,000 in cash, you're in your 40s. You may say, hey, I'll over the next 5, 7, 8 years, I'll convert to 50K and I'll take a little bit of income this year. And if I have losses, a lot of losses this year, I'm going to take more. And if I don't have a lot of losses this year, I'll take less. And each year I'll kind of determine the amount I convert based off deductions and losses so I could reduce the tax impact of the conversion. That's really the core of today's video, is thinking about how do you reduce the tax bite on a conversion. Conversions are great. It's an amazing tax advantageous bridge to take income that would be subject to tax and move it into a bucket that would be tax-free. I mean, it's the ultimate tax play. It's what all tax lawyers get excited about. There's nothing more exciting. That's why I love what I do, because I can take my knowledge as a tax lawyer and my belief in the retirement system and marry them and help people maximize their retirement and tax benefits and hopefully shelter their retirement income and gains from taxation. So you don't have to worry where tax rates will be in 5 years, 10 years, or 30 years. You don't care, because everything is going to be tax-free to you, your spouse, and your heirs when you pass. So trust me, I have comfort at night. I go to bed, I'm obviously stressed about, lots of different stuff in the world, but I know all my retirement accounts are Roth. I have life insurance. Like, God forbid I go, I know my wife, my kids, they're going to have tax-free income, which gives me, a little bit of comfort to know that, hey, I'm leaving them a legacy that's going to be 100% tax-free. Okay. Yes. IRAs and Roth IRAs are part of your estate, and insurance through using some estate planning can get the insurance out of your estate. But right now, the uniform credit's very high. It's over $12 million. So for most of us, if your IRA is part of your estate, you're not going to pay estate tax if your overall estate's under 12 or so million bucks. Could that drop in future years? Yeah. But the fact that it's going to be tax-free is what gives me the comfort. So any smart person who has a pre-tax IRA should be thinking every month, at least every year, can I make a conversion? And if I do a conversion, are there ways to reduce the tax? Number one is a discount evaluation, which I'll talk to at a later point. Number two, can I use losses? Okay, and that's today's video. Can I use losses more than a $3,000 capital loss? Are there other active or maybe some passive losses that are available that can reduce the bite of the conversion? Because if you're able to reduce the taxation on a conversion, what you've been able to do is take income or assets that are going to be subject to income tax, ordinary income tax, IRA distributions, require minimum distributions, are subject to ordinary income tax, not capital gains. So tax rates can go as high as 37%. So the higher your income is, the more valuable a Roth conversion is, and the more value having a Roth IRA is, right? If your tax bracket's at 10%, having a Roth IRA is good. I mean, you save 10%, but it's not as good as if you pay 34% or 37%. So if you are middle income, high earner, you think you're going to have high income, you want to get your assets into Roth, you feel like you're a good investor, you're going to hit some doubles, triples, home runs, you want that money to grow without tax. The ultimate prize is if you can find a tax effective, less costly way to move those assets from pre-tax to Roth. Best of all, obviously, reducing the tax to zero. And I've done some presentations on using oil and gas investments, for example, to generate high deductions to offset Roth conversion gains. I've done a webinar with an oil and gas expert on this, and it's something I'll do in the future, maybe on another one of these tips of the week. But really, today's video again is just, if you have losses, net operating losses from prior years, remember, they're available to be used carry forward, and those losses could not only reduce your taxable income, but could also reduce the income on a Roth conversion, which ultimately will allow you to take income and gains and assets that are subject to ordinary income tax and then shelter all those gains from tax. So long as you're over 59.5, the Roth's been open at least 5 years. That's it. That's today's video, tip of the week. Hope you guys enjoyed it. It's a fun little series that I just started. Generally do these every Friday. We'll see next week. I'm going to try to do them. It's Thanksgiving next Friday, but hey, this is fun stuff. Everyone's going to be full, tired of watching football. So maybe some of you guys will enjoy watching another tip of the week. Otherwise, hope you guys enjoyed it. I would check out these tips every week. Obviously, you want to subscribe to our amazing YouTube channel where you're getting 3 to 4 videos a week, 3 podcasts a week, just an unbelievable trove of content related to self-directed retirement accounts, alternative asset investments, tax strategies. Really, it's the place to be. If you care about being a very successful, smart investor and you are focused on using your retirement accounts and the IRS and tax system, Internal Revenue Code, to benefit yourself, then this is the place. There's not many people that know more about this stuff than I do. Not that I know a lot about anything else other than sports and retirement accounts. I can't even open the TV, but I know a lot about this stuff. So hopefully you're interested. Hopefully you're learning. Hopefully I can take my tax background, my master's in tax degree, my 9 years of big firm experience, my 15 years of running one of the leading self-directed retirement companies in the space, and educate everyone and make people richer and smarter investors. That's my goal. Hope you guys enjoyed it. Have a great rest of your day, and I'll see everyone again on this channel next week. Take care.